There are Uber and Lyft drivers who believe they'll be able to take advantage of the no tax on overtime even as independent contractors. I'm going to debunk that myth so that you don't get audited, and then I'm also going to show you 10 real legal ways the big beautiful bill will impact us as rideshare drivers. Some are good, some are bad, but there's one in particular that has me concerned for the future of rideshare. The first point that we'll touch on is the no tax on tips deduction. This is a temporary deduction, not a credit. A credit reduces your tax bill dollar for dollar, and this deduction reduces the amount of income that is subject to tax. It's what we call above the line deduction, meaning you subtract it from your gross income to determine your adjusted gross income, or AGI. Now, because this is an above the line deduction, you can take it even if you use the standard deduction. So that means if you want to use your mileage to lower how much taxes you have to pay, this can be used in addition to that. Now, there are two limits to this deduction. The first is the annual cap. You can only deduct a maximum of $25,000 in tips per year. I saw a really bad comment on Facebook of someone who thinks that if you make more than $25,000 overall, you won't be able to claim this deduction, but that's not true. It's just tips. Once you make more than $25,000 in tips, that will be taxed. The second cap is that the deduction phases out if your modified adjusted gross income is over $150,000 if you're a single filer, and over $300,000 if you're married and filing jointly. But because rideshare drivers can claim so much from mileage as tax write-offs, you probably won't hit these limits unless you're working a lot. And I mean a lot. Keep in mind this deduction is temporary and is only available for the tax year 2025 through 2028. Here is a real world example to explain this a little better of how it will impact us. Let's say you earn $55,000 a year. With a 15% tip rate, that comes out to $8,250 in annual tips. Your $8,250 in tips is below the $25,000 cap, and your income is below the phase out limit. Therefore, you can deduct the full amount. You subtract the tip deduction from your gross income, your adjusted gross income drops from $55,000 down to $46,750, and you will only pay federal income tax on that lower amount before applying your other business deductions like your standard mileage deduction. But what does that mean in real dollars? To find out, we're going to start a running tally of all the potential tax savings from this new bill and this new rule. That $8,250 deduction and a 22% federal tax bracket equals $1,815 in tax savings. So that's actual money that you're saving if you meet those averages. And as we go through all these points, we're gonna keep track of them. So let's move on to the second way this bill will impact you. Now, this one doesn't add to our savings tally, but it does save us from a major headache. So this new law repeals the $600 1099K reporting rule. The rule exists from the American Rescue Plan that required platforms like Uber and Lyft to issue a form 1099K for payments over $600. Platforms are only now required to issue you a 1099K if you receive more than $20,000 in payments. On top of that, you also have to have more than 200 transactions. So that would be more than 200 rides. And this change is retroactive. So it'll apply to this entire year. For part-time drivers, this will simplify tax season. You're not gonna receive this form, which if you're me, you want to receive this form, but if you don't want to worry too much about it, I guess you wouldn't want to receive this, then that's fine. But it is important to remember that this does not change your tax liability. And this is your warning. You are still legally required to report all of your income to the IRS, whether you receive a 1099K or not. This is why I would prefer to receive it regardless. Let's move on to the third way the big beautiful bill will impact us as rideshare drivers. So this is another change that's going to simplify paperwork, but again, won't add to the savings tally. It's the increased reporting threshold for forms 1099 NEC, which is non-employee compensation, and the 1099 miscellaneous. These are both tax documents that we get as Uber and Lyft drivers. This applies to income you might receive directly from a platform such as referral bonuses or other incentives related to Uber and Lyft. From a company, you as an independent contractor is increased from $600 to $2,000. Platforms will only issue these forms if the total of these types of income for the year exceeds $2,000. And if you're watching this channel, even if you're doing part-time, it should. You should be making more than $2,000 a year. But let's move on. The next way the big beautiful bill will impact us as rideshare drivers, this is now point 4. This is the new temporary deduction for interest paid on a car loan. This one is found in section 70203 For any of you who want to pull up the big beautiful bill yourself and confirm what I'm saying, this will go from tax years 2025 through 2028, and this provision creates a deduction for up to $10,000 in interest that you pay on a loan for a qualified passenger vehicle. This deduction has very specific limitations that you need to understand. First, the vehicle itself must qualify. The law states that vehicles' final assembly must have occurred in the United States. This means that you need to verify where the car was built and not just the brand of the country's origin. Here's what I mean. You cannot assume a brand's country dictates where a specific car is made. For example, you might think a Japanese brand like Honda or Toyota wouldn't qualify. However, many 2025 Honda Accords are built in Indiana and Toyota Camrys are built in Kentucky, making them potentially eligible. I'm not saying they are. I don't know the rules. I'm not a tax specialist. I'm regurgitating information for you. On the other hand, you might assume that an American brand like Chevrolet always qualifies, but some 2025 Chevy Silverados, which you should not be driving for rideshare, are actually assembled in Mexico or Canada, which would make those specific trucks ineligible. Again, you should not be driving trucks for rideshare, but people do it. I think you guys are insane. Now, a car like the 2025 Mazda 3, which is assembled in Japan, would not qualify. It just straight up wouldn't. Ignore the logo itself and check where that specific model is being built. I believe this is called the Monroney sticker. I might be pronouncing that incorrectly. First time I've ever seen that word in my life. But by law, it must list the vehicle's final assembly point. Second, your income is a factor. This deduction is phased out for higher earners, but let's see if we'll even get there considering we're Uber and Lyft drivers. The phase out begins if your modified adjusted gross income is over $150,000 if you're a single filer, or $300,000 if you're married and filing jointly. Most of us will not have to worry about that. Now, here's a little warning. Do not take on a car loan just to get a tax deduction. Having no car payment is always better than having a car payment with a tax break. The new rule does not make interest free. It only reduces the amount of tax you pay on the interest. You are still paying the interest. Let's break that down using real world math. Let's say you take out an average new car loan, which is around $42,000 at a 7% interest rate for 6 years. In the first year of that loan, you will pay approximately $2,840 in interest alone. If you're in the 22% federal tax bracket, this deduction saves you about $625 on your tax bill. So this is what you really need to understand. You paid over $2,800 to the bank in interest, and the deduction only gave you back $625 in tax savings. So your net cost of your deductible interest is still over $2,200 for just 1 year. The deduction helps, but it's not free money. The best way to save money on interest is to not have a car loan in the first place. However, it does add to our savings. The $625 in tax savings from our example gets added to the previous total, bringing our running tally to $2,440 if you're the average rideshare driver making $55,000 a year. That number. So this next part of the bill is where the savings tally takes a massive jump. The law makes 100% bonus depreciation permanent. This allows you to deduct the entire business use portion of a vehicle's cost in the first year you place it into service, rather than spreading that deduction out over several years. This can create a massive reduction in your taxable income for the year you buy a car. This is huge. I'm gonna love this. You're gonna love this. Now let's show some real world math. You buy a $42,000 vehicle based on your mileage logs. You determine your business use is 85%. And hey, if you need a mileage log, you can become a member and get access to the one I have. I should be showing you examples of how it works right here. Lyft is banning people for people who use apps that are pulling data from their apps, right? Here's the message they've been sending to everyone. My spreadsheet doesn't do that. You put it in yourself, you become one with your numbers, and you get a good breakdown. But let's get back to the content. So you determine your business use is 85%. This means you can take on a one-time bonus depreciation deduction of $35,700. That's 85% of the total cost of your new car. That $35,700 deduction is a 22% federal tax bracket, which translates to a direct tax saving of $7,854. This one deduction alone can wipe out a significant portion of your tax liability for that year. So if we add the $7,854 to our previous total, our new running savings tally skyrockets to over $10,000. So this next part of the bill, It's going to be in contrast to our savings tally. It's actually going to be a lost potential benefit. The bill terminates several key tax credits that have made electric vehicles more affordable. It's going to make buying a new electric car or even used cars less worth it. The credits for new, used, and commercial clean vehicles will end for vehicles acquired after September 30th, 2025. The credit for installing home chargers in your home is going away this month, but next year in 2026. Let's look at the math of how this will actually impact certain people. We're going to use the 2025 Tesla Model Y as our example. Before the deadline, the $7,500 federal tax credit brings your effective cost down. After September 30th, that incentive is gone, but I already know what a lot of you are thinking. You're going to try to combine this expiring $7,500 credit with your new car loan interest deduction we just discussed, plus the 100% bonus depreciation so you can write it off on your taxes. But this is really important. The math does not justify the debt. The interest deduction might save you about $625 in taxes in the first year. Even combined, a total tax benefit of around $8,100 does not justify taking on a $48,000 loan for a depreciating asset. Even if you don't have to pay any taxes for that year because you're getting the 100% bonus depreciation, you still have a car payment of over $48,000. Working for companies that are actively trying to replace us with self-driving cars and lower our pay. Do not fall into that trap unless you're paying cash. If you pay cash and you fall into a trap, at least you know it's not going to hurt you in the future. And at least you know you're not going to have a car payment that you can no longer afford. On top of that, you have to remember that the new car's value plummets the second you drive it off a lot. For a car like a Model Y, this is a massive depreciation that can instantly put you thousands of dollars upside down on your car loan, owing the bank more than the car is actually worth. It's straight up a financial trap. This is exactly why the smart financial move has always been to buy used. But the new bill also hurts that strategy too. You can find this underneath the $25,000 limit where you would qualify for the used clean credit for a used vehicle. Before the deadline, you can get the used Model Y for an effective cost of $21,000 by using the $4,000 used EV credit. After September 30th, that credit disappears. This bill makes the most financially responsible way to get an EV significantly more expensive. But for all of you wondering if you should go and rush out and buy a EV because the tax credit is expiring, here's my advice for you. Don't rush to take on a new loan just to get a credit before the deadline. A $4,000 or $7,500 credit is worthless if it pushes you into years of debt that you can't afford. The correct financial move is to ignore the deadline and focus on your own balance sheet. Pay off your existing debts, build your emergency fund so that a single car repair doesn't bankrupt you, and start saving for the goal of buying your next car with cash. When it comes to rideshare, this is how you secure yourself to build wealth. And these are all things that I have done already. I started with a car loan, I paid it off. I could have traded it in, took out a new car loan. Now I have no car payment, and if something ever happens to my car, I don't have to worry about it. All right, so let's move on to the seventh way the big beautiful bill is going to impact rideshare drivers. So this next change covers broad changes that affect your overall tax liability. Let's just jump into an example. Let's say this amounts to a $1,500 increase for you as a single filer. A 22% tax bracket, that increased deduction saves you $330. Second, the child tax credit is increased from $2,000 to $2,200 per child. A tax credit is a dollar for dollar reduction to your tax bill, so that's another $200 in direct savings. We add the $330 from the standard deduction and the $200 from the child tax credit to our previous total, and if you have more kids, just multiply that number. Our running total so far for all the money, real money, we're saving on taxes is now over $10,800. Here's the eighth way the new bill will impact us as rideshare drivers. This one works against us because now it's going to limit our ability to take savings. The bill makes permanent the rule that limits the amount of net business loss you can use to offset other income. If high expenses on a large vehicle deduction gives you a net bonus loss for the year, the rule can prevent you from using the full loss to lower your overall household tax bill. So let's say you took a loss of $100,000 and your wife, she made $90,000. You can't say that your income was negative $10,000. So it's just putting caps on it. I don't know exactly how the caps work. I don't know what the thresholds are. I don't think it's too important for us, but it's something that we need to keep in mind. Before I move on to number 9, I just want to remind you that at the end, I have to explain to you why some rideshare drivers think they'll be able to take advantage of no taxes on overtime as independent contractors. So let's get through these two last points first. So while point number 9 is not a tax savings, it is a separate financial benefit that if you have a child during these specific years, you're going to want to hear about. The bill establishes a program where parents can elect to have the government make a one-time $1,000 payment into a new tax advantage Trump account for any child born between January 1st, 2025 and December 31st, 2028. This provides a seed contribution for your child's long-term savings. This account essentially functions like a Roth IRA that the child can access at 18 and then 50% of it at 18 and then the other 50% at 24. It's more of a college savings account. I guess the government is trying to get us to be more financially literate in the lives of our children rather than relying on student loans. I think it's a good idea, and I just had a kid this year and I'm definitely going to get it. Now, here's point 10. This is the one I said was most concerning to me at the start of this video. When I'm done telling you about this, I'm going to finally tell you the story about my friend's genius S-Corp plan to get tax-free overtime and exactly why it's a trap that you need to avoid. So point 10 is not about a tax saving, but it's about a long-term threat to our income that's buried in section 71119 of the big beautiful bill. The new federal Medicaid work requirement. You might be thinking this has nothing to do with rideshare, but it does. Starting in 2027, states must require certain able-bodied adults to prove they are working at least 80 hours per month to keep their health covered. Okay, Tristan, so what? The CBO, the Congressional Budget Office, projects that this rule will cause 5.2 million people to lose their insurance. Okay, so what? Now, the common assumption is that it targets people who aren't working, but that's not correct. The data shows the real group at risk is the millions of low-wage workers whose hours are unstable from month to month. One month, they might get 90 hours. The next, they get 65. They are the ones who will be scrambling to fill the gap to avoid losing their healthcare. Because of its flexibility and low barrier to entry, ride-sharing is the path of least resistance to them to top up their hours. Based on this, the Central Forecast projects an influx of approximately 780,000 new drivers in the US market. That's almost 1 million more drivers. That represents a 17.3 increase in the total driver supply in a very short period of time. The supply shock will almost certainly outpace the growth in rider demand, leading to market saturation that we are already facing with other humans and with self-driving cars. With more drivers on the road, your idle time between trips is likely to increase, and there will be more competition for the most valuable rides during peak surge hours, if it starts peaking at all. This is a longer timeline threat to your profitability that you need to keep an eye on. Okay, so that was the final legislative change that you need to track. Now, as I promised at the beginning of the video, let's talk about the clever idea that my friend had to get around one of these rules. So my friend told me that he wants to form an S corporation to make himself an employee, put himself on payroll, and then pay himself a tiny salary. And then he would just pay himself a ton in overtime to get that new tax deduction. But here's why this is a guaranteed way to trigger an IRS audit. The IRS has a rule called reasonable compensation, and it means S-Corp owners who actively work in the business must be paid a reasonable salary for their labor, and that salary is subjective to payroll taxes. The IRS will look at this plan, reclassify the overtime as what it really is, your actual salary, and send you a bill for back taxes, penalties, and interest. So it's a plan that sounds smart, unless you're actually a lawyer or a tax professional. So when I told my friend this, he came back and said, okay, what if my wife is the owner on paper and she just pays me as a regular employee with all that overtime? I told him, this is an even worse idea. The IRS operates under a doctrine called substance over form. They don't care what the paperwork says. They care about the economic reality. Who is actually performing the work that earns the money? You are. Therefore, the payments you receive are for your labor. The IRS will rule that your wife's company still has to pay you a reasonable wage for your work, and trying to hide that wage as a tax deductible over time is a form of tax evasion. You don't want to piss off the government. The takeaway is pretty much this. Don't get too cute. Do what you can. Take advantage of what's in front of us and don't try to game the system. Make sure you like and subscribe. Check out this video of how much money I made and the spreadsheet I used to track all my income, business expenses, taxes, and gives you the real number of what you make at the end of the day. Have fun with it.